In one of our previous video, I received this message asking if it's better to invest in equity funds or in individual shares. And today we are going to break this down to see which one is better. And the reason why we are doing this is because we have seen equity funds giving up to 54% returns on investment. So is it better to invest in individual shares or should we take advantage of the equity funds? First, we start with the definition because I think this is the first difference that we see between equity funds and shares so that we also understand what they are. So an equity fund is a type of investment fund that pulls money from different investors or multiple investors to buy shares of publicly traded companies. These are companies that are listed in stock markets or they're listed in Nairobi Securities Exchange. I know we have companies that also, or equity funds that also invest in global markets, but currently most of the equity funds that we have here in Kenya, they invest in the local market, okay? So we are talking about Nairobi Securities Exchange. These funds are also called stock funds because they primarily invest in equities and according to the law, they can invest up to 80 or 90% of the investors' money in the stock markets. And here are two examples, a CIC equity fund and ICA Lion equity fund. And the reason why I took these examples is because for us, and the reason why I included these examples here is for us to see the structure or where they actually invest the investors' money. And from this screenshot, you can see that they have the largest percentages in equities or in shares. So if you go through a fund fact sheet and see the largest percentage is in equities, then that tells you that that particular investment or that fund is an equity fund, okay? Now, here are the most important things that you need to know about equity funds. Number one, you contribute money and give the money to a fund manager or a professional who invest in shares on your behalf, okay? Number two, you don't decide which companies to invest in and you're not involved in where the money is invested. You just contribute and they make the decision for you. Number three, because they are collecting money from different people, they are required by law to diversify the investment to mitigate the risk of losing people's money in a single stock or in a single company. The law states that they cannot have more than 10% of investors' money in shares of a single company. So they invest in more than one security. Ideally, it's supposed to be diversified. It's supposed to have multiple shares in that particular portfolio. Okay. Now, as for shares, you invest in companies yourself. You are responsible for searching or researching which is the best company to invest in. You are responsible for doing your due diligence on the companies to find out whether they have financial health or they are in debt or they have crisis in their company. That is on you to find out. After doing your due diligence, now you'll need to start investing in shares. And for this, you need a few things. Number one, you'll need a licensed stockbroker. And then stockbrokers will give you the platform to access the Nairobi Securities Exchange and they will help you get the CDS account. A CDS account is an account that will help you trade in shares. Then you will need to use their online trading platform or the stockbrokers trading platform for you to be able to buy the shares, or you can actually request them to buy the shares for you. Of course, sometimes it comes with an extra charge or an extra fee, but I know there are some stockbrokers that do not charge extra for this, okay? Now that we know what equity funds are and what shares are, we can go to the real differences. And here is a table I created for a side-by-side comparison. I find it easier if we do this because you're able to appreciate the differences, okay? And the first thing that you're going to discuss is diversification. So for equity funds, as soon as you invest your money in an equity fund, your money is diversified or your investment is diversified across different stocks. As we mentioned earlier, they are required by the law to diversify. For shares, you have to diversify at a personal level. You have to choose several shares to invest to avoid putting all your money in the same basket. So for equity funds, it's an instant diversification as soon as you invest. For shares, you will need to do your due diligence, find different stocks and invest in them, individual shares, okay? You have individual shares, but you invest in different shares, all right? The second feature we discuss is the control. In equity funds, as an investor, you don't have much control, or you don't have control over what happens to your money. Even if you think the shares of a certain company will do very well, you can only trust that the fund managers knows that as well, and they will make the best decision on your behalf. In equity funds, you rely on how good the team managing the fund is. In fact, you will not know which shares they have invested. The best they can do is to highlight the sectors they have invested in, but for the individual shares, you'll not be able to tell which shares they have invested in. And for shares, you have the full control on where to put your money because you are responsible for choosing the stocks. And number 3 is time commitment. Of course, it goes without saying. For equity funds, you don't need much time because you only need to deposit the money. And when it's the right time to withdraw, you just need to withdraw the money. And this is as easy as pressing a button and depositing and withdrawing. And then for shares, you need to do your due diligence, you need to open the accounts, and you actually need to do the actual trade by yourself. So as we mentioned in our definition, you can actually tell a stockbroker to buy the shares on your behalf. And I'm bringing this back because if you tell the stockbroker to buy shares on your behalf, it's going to take more time than you buying the shares yourself, because there'll be that communication between you and the stockbroker. Buy this, sell, buy this at this particular price. I'm going to deposit money now. Deposit money, and it's supposed to be maybe through email, or maybe a call. So it takes a lot of more time than if you're investing the shares by yourself. Okay, and now I think it's good time also to introduce the fees here. The fees that you pay for an equity fund is usually less than what you would pay for brokerage fee, especially if you are buying and selling regularly. Okay, so let's take an example. If, for example, we are investing 100,000 Kenya shillings, we are investing this in both equity fund and in shares. So with equity funds, you get to pay 2% management fee. Most of the time is 2%. Can be lower than this, 1.5%, or higher, 2.5%, but most of the equity funds in Kenya, they charge 2% management fee or lower. Okay, so 2% of 100,000 Kenya shillings, that you'll be paying 2,000 Kenya shillings as management fee. I know that some equity funds, they also charge performance fees and entry fees, but most of the equity funds that we have here in Kenya, again, they only do 2% management fee. So for 100,000 Kenya shillings, you're going to be paying 2,000 as management fee, and this fee is typically deducted from your investment automatically, so you won't be able to see a separate charge. It just slightly reduces your returns over time. So when buying individual shares via stockbroker fees in Kenya, they vary, but here is a typical breakdown of how it looks like. So first, we have the brokerage commission, that is around 1.5% per transaction. That is a buy or a sell. Or if you're doing an amount below 100,000 Kenya shillings, you'll be charged around 1.78% for per transaction. Other charges include CDST fees, CMA fees, NSC fees, and these combined will add up maybe to about 0.3% to 0.5%. So when you're buying and selling, these are two transactions. So when you buy, you're going to be paying the 1.5% plus 0.3%, and then when you're selling, you're going to pay around the same. So for a buy and sell, you're going to be paying approximately 3.6% of your investment. Okay, so for 100,000 Kenya shillings, the buy side maybe fee will be 1,800, and then the sell side fees will be 1,800, and the total fee for the transaction, a buy and a sell, will be 3,600. Okay, I really want you to understand these fees because this is something you need to consider, especially for people planning to be buying and selling the individual shares. You don't want to be playing a zero-sum game or making losses. And I know sometimes these fees, if you're doing so many transactions, they can add up over time. Just understand the brokerage fee is charged on transaction basis. It's not like it's charged on the amount that you're investing. It's every time you're doing a transaction, you get to pay the brokerage fee. So it's best to buy and hold for long term, or for a long time, for you to realize profits. If you do trading like every day or every now and then these fees can add up very quickly. So make sure that you're investing for long term. Go in with money you don't need in the short notice, or you don't need in the near future, so that you're able to be in the market long enough to see the market doing well. Like it can move from one price, maybe you are talking about 15 Kenya shillings, all the way to maybe 40 Kenya shillings, 35 Kenya shillings. A huge difference in between the prices. For equity funds, you can withdraw at any time. Just make sure that you're not withdrawing at a loss. Make sure that whatever you bought, you're selling at higher price than that. So also equity funds, they are long-term investments, so you want to go in with money that you're going to be putting there for a longer period of time. Okay, so make sure that you're investing for long term. Go in with money you don't need in the short notice, or you don't need in the near future, so that you're able to. So the next thing that you're going to be discussing is the risk, and I would like to mention that individual shares are more riskier than equity funds, because you remember that we have talked about diversification in equity funds. So the risk is spread across different stocks, and even if one stock is not doing so well, the others can cover for that particular stock that is not doing well, except in cases where the stock market is generally not doing well. And in such a case, a fund can report a negative figure. It can report a negative value because the stock market in general is not doing very well. And we have seen this especially in Kenya, and I'm going to share a screenshot here so that you can see for CIC equity fund, they returned negative returns in 2021, 2022 and 2023, and these I guess it's because of political issues and economic issues. So in case a market is not doing very well in such a period, sometimes it can report a negative return or a negative figure, as you can see here. I think I should work on a video on how the equity funds returns work, because they are calculated very differently from other investment, and sometimes the returns can be misleading, and I know that most people have been misled because of the returns that we see in equity funds. And because we agreed I do videos that are 15 minutes maximum, I have to cut this video here because I recorded the full video and it was 30 minutes plus. So I decided to cut it, and I will upload a part 2 later. So make sure that you stay tuned for that. And if you have not subscribed, please do so that you don't miss out on the next video. We have not discussed which fund or which investment has better returns than the other, and we have not also discussed which one is easier to monitor. In our next session, I will also do or give my opinion based on my analysis. So make sure that you stay tuned for that. And for those interested in investing in shares, I have created an ebook that contains everything that you need to know about investing and making money through shares. So if you're interested in this, contact me at this number 0706 651438 and get yourself a copy. The ebook also contains links to resources you need to check prices, shares that are performing well, shares that offer dividends, and links to help you with the due diligence. We'll continue this discussion of equity funds and individual shares in our next part 2 of this video. See you there. Happy investing. Bye.